It's the most wonderful time of the year, folks. December kicks off on Monday. We will take a look at seasonality for December and see how the Santa rally is setting up for 2025. We will also cover the latest news on Opendoor and see how that is setting up, and Bitfarms, which has been on a bullish tear the past couple days with the recovery we are seeing in Bitcoin. We will cover the major macro themes as well, including some of the worst performing tech stocks in the month of November and where you might be able to find some bargains, and also the Fed's looming rate decision on December 10th. All that and much more on this week's market prep video. As always, if you get value from these videos and you want to help us out with the algorithm, make sure to share with a buddy. Don't forget to like, subscribe, follow us wherever you listen to podcasts. And now, folks, as always, let's roll. I'm Brandon. Welcome back to Stonkcast, the market show for the average Joe. Whether you're a diamond-handed degenerate or a more conservative swing trader or investor, we've got you covered. If you'd like to support the channel beyond liking and subscribing, make sure to check the links in the description. All right, folks, it is time yet again for the market prep video. Happy Sunday. I hope everyone had a fantastic Thanksgiving. Black Friday essentially kicked off the beginning of the Christmas season. December starts tomorrow, which is historically the beginning of the Santa rally for the overall stock market. We're going to dig into all that in this episode, take a look at December seasonality, see how things are setting up. We'll take a look at some tech stocks that really shed some gains in the month of November off some of those AI valuation fears. And we're going to see where we can find a bargain heading into 2026. But first of all, let's kick it off with Opendoor and see how Opendoor is really setting up heading into the month of December and see where we could be headed, right? For the beginning of 2026, we had Eric Jackson putting out some messages on X or Twitter over the past week, talking about how Opendoor is entering version 2.0. We're off the heels of the Q3 earnings report and right smack dab in the middle of Q4. We'll be very curious to see what Kaz and the team are putting together, right, for Q4, what those numbers are going to look like next year. But as of right now, let's take a look, first of all, at this piece here. This website here, Tech Stock 2, they've basically been putting out just these articles, very cleanly organizing all the information you need to know about Opendoor. I love it. Discovered it a couple weeks ago. It's ts2.tech is the website if you want to check it out. But first of all, I just want to take a look here at some of the latest news. This was from November 28th. And basically, according to Benzinga, Eric Jackson calls this Opendoor version 2.0. In a new Benzinga article published early Friday, investor Eric Jackson describes Opendoor as entering a version 2.0 era under new CEO Kaz Nejitin, formerly COO at Shopify. So just basically some key points from the piece, right? Opendoor recently had around 1,400 employees, but under Nejitin, it is planning to replace 80 to 90% of its workforce with AI-driven automation, according to Jackson's comments. Tasks that previously required 11 people to process a single home sale are now being handled by one person, with AI doing most of the heavy lifting. A change, Jackson says, happened in the last month. The strategic goal is 3-day closings, letting sellers get an instant offer and financing in the app, then closing in days instead of weeks. That's massive. I mean, if you take a look at real estate historically, one of the knocks on it, it's such an archaic process that can take a long time to close on a house. So this is obviously a major pain point for a lot of individuals selling homes and really even buying homes. That process takes a while as well. But the fact that Opendoor is tackling these two pain points is a big deal, right? And should create some more attractiveness for those looking to sell. At least that's the goal, right? 3-day closings is a lot better than taking multiple weeks there. Jackson sets an extremely aggressive long-term target of $500 per share. That's wild. While JP Morgan's Day-K Lee reinforces the bull case with an overweight rating and an $8 price target, roughly in line with where the stock trades now. The message from today's Benzinga piece, Opendoor is trying to reinvent itself as an ultra-lean AI-first housing platform and some high profile investors are betting big on that pivot. So obviously we had the Q3 earnings, as I mentioned earlier, and Kaz really highlighted the emphasis on AI for Q4 and beyond, right, for Opendoor. And so, Jackson is essentially just backing that statement from Kaz and saying Opendoor is now entering version 2.0, reducing some of the workforce. We've heard Keith Rabow, chairman of the board, on various interviews state the fact that Opendoor has way too many employees. They do not need that many employees. And so the fact that, as this article lays out here, under Negitin, the plan is to replace 80 to 90% of its workforce with AI-driven automation is in line with some of the comments we've heard from Keith Rabow regarding Opendoor. So very interesting stuff here. I do like the idea of a 3-day closing process. That would be revolutionary for Opendoor. And, just to kind of go through some other, key points of this article here from Tech Stock 2, obviously it talks about how volatility remains the norm for Opendoor right now as the retail community continues to be, involved, right, in Opendoor. And as it says here, why everyone is talking about Opendoor 2.0, today's article, built on a narrative that really started with Q3 results on November 6th and the company's open house presentation on its AI pivot. Just a brief review here. Q3 2025 by the numbers. Revenue about $915 million, beating estimates of around $880 to $890, but still down roughly 33 to 34% year on year as the company deliberately ran with lower inventory. Gross margin shrank to roughly 7.2%, down from around 11.5% a year ago. We won't go through all these, but Q4 revenue down 35% sequentially due to low starting inventory. So, as far as the guidance for Q4, obviously, as we mentioned, post-earnings report back on November 6th, they did guide down, and part of that is due to the fact that their inventory is getting restricted, which in a sense, I believe is a good thing. The AI first pivot under Kaz Negitin, obviously, he's looking to pivot the company. Part of the reason why Keith brought him in, right? Because of this AI pivot that Opendoor is looking to take. And I've said this before, the full name of the company, folks, is Opendoor Technologies, right? So obviously the emphasis on AI is right in line with the brand, in my opinion. And we got the warrants out. Everyone who owns Opendoor shares prior to November 18th should have received by this point in their, respective brokerage accounts, warrants that can be exercised if the stock goes the right way. So these are just some of the key points here. Obviously, you got some tailwinds on the macro front for Opendoor, which we will get into later in the episode, such as, rates and that pending rate decision on December 10th is going to be a big deal. But this was an interesting piece of the article here, bull versus bear case after today's news. So basically, just to kind of summarize it, the bullish view on Opendoor, radical efficiency potential. If AI really can cut the workforce by 80 to 90% while maintaining or improving service quality, the long-term margin uplift could be enormous. And then the bearish view with the skeptics' emphasis, the core business is still unprofitable with negative EBITDA margin and widening gap losses in Q3. So there's some other key points here, but for sake of time, I'm not going to run through all these. But again, this is ts2.tech. Techstock 2, great website. They've been putting together some really good stuff on Opendoor here. So speaking of things, let's do a quick check-in on Opendoor's chart here. For those on YouTube, taking a look at the daily chart on Opendoor. And if you can see here in the top left-hand corner, this is based off of volume-weighted average moving averages. The stage that Opendoor is technically in right now is one of accumulation on the daily chart, which is a good thing. Obviously, the markets were closed for Thanksgiving, and then Friday was a shortened trading day. It was a really, low liquidity day, not a lot going on, and that's kind of backed up by the fact here that if you take a look at the volume that we had on Friday when the markets closed at 1 p.m. Eastern, they were super low. We only had 55 million shares transacted on Opendoor. I mean, that's only 23% of the 90-day average volume on Opendoor that happened on Friday. Again, it was a shortened trading day. Markets were open from 9:30 a.m. to 1 p.m. Eastern, half a trading day. Not a lot going on. I didn't really expect a whole lot. Technically, on Friday, though, we did close below the 50-day moving average, but we are running into the 5 and also the 20-day moving average. And we're kind of, as I've said before, right, we're in this range on Opendoor, which I believe is between, $7 being the floor and $8.50 being the ceiling. And we've basically been bouncing back and forth with a couple breaks out of the ranges here and there. But overall, basically since the beginning of October, for the past 2 months, this is where Opendoor has been. And if we do quick check-in on the RSI for Opendoor, we're sitting at 51. We're basically neutral on the RSI right now. So we're really just looking for the catalyst to get this thing moving again. I do like the fact that we are above 7. That's great to see. And we have been holding for really the past, 4 sessions, some of the gains that we had off those lows of $6 all the way up to 8.14, which is great. And if we continue to see the market rally heading into the end of the year, that could be tailwinds for Opendoor. So that's where we're sitting on the daily chart. I, of course, want to see a break above 850. Technically, the Fibonacci level is $8.44. Want to see a break above that. We have this descending level of resistance that you can see right here. It's basically just the 2 touch points of the 1087 3-year high and then the high that we had on November 12th. So want to see a clean break in really, at this point, the major level, in my opinion, which would signal or indicate, right, that we're going to get a new 3-year high, would be a break and close above 965. That is proven to be an area of consolidation back here in September, and then was resistance in early October, and then early November as well. So for the week ahead, best case scenario, we get back above 850, and we get a retest of 965. And that could come if we see some volume increase, if we get some news headlines, anything like that, any more dovish tones that could send, the Russell 2000 shooting for the moon. That could definitely help Opendoor as well. All right, let's do a quick check-in on the options chain for Opendoor. And, again, Friday session, low liquidity, not a lot going on. You only had 182,000 calls and puts transacted, options transacted, low liquidity relative to what we're used to seeing on Opendoor happened on Friday, but you did have a put to call ratio 0.24. So for what it's worth, it was bullish. So that's what we got right now for Opendoor. We do have a full trading week, Monday to Friday. We don't have any half days or market close days for any kind of holidays. So first full week of December, it's going to be very interesting to see what happens with Opendoor. It does look like the Santa rally is back on if you look at the S&P and the NASDAQ and the major indices. So that should be a tailwind for Opendoor. Let's see if we get any more commentary from the Fed, and we're going to get into that later. But again, the rate decision happens on December 10th, which is next Wednesday, a week from this Wednesday. And so that, of course, would be helping out Opendoor as well. And we have seen mortgage rates come off a little bit over the past week towards the end of November, which is also very interesting because that gives Opendoor liquidity. If mortgage rates are lowered and people are getting back into the game, so to speak, as far as buying and selling homes, that is more liquidity for Opendoor, which is exactly what they need for their business. So drop a comment. Let me know what you think about Opendoor. All right, let's move on to a couple of stocks on the Stonkcast watch list that I want to cover here. First of all, I want to take a look at LMND. So LMND is one that we've talked about for a while. As far as an AI disruptor, we've said this before and, I'll say it again, but they're basically looking to do to insurance what Opendoor is looking to do to real estate as far as AI, right? So LMND is an interesting company, small market cap, I think 4 or 5 billion. And, obviously a low float considering the fact that at 4 or 5 billion market cap, the price of the shares are at 78 and change right now. It was up 0.7% on Friday. And if you look at the daily chart, it looks beautiful above all the major moving averages. We got that high of 83.77. And, it looks like it wants to take a crack at that again. So if we get above 83.77 on Lemonade, I could see a run, especially if small caps are, behaving well. I could see a run to 100 on Lemonade over the next, I would say, 2 to 3 months. That's just my, humble opinion on this, but definitely a stock I like. And as far as the options chain goes, fairly bullish, not a ton of liquidity compared to like Opendoor, but it does have a put to call ratio 0.50. So twice as many calls as puts being bought there. And the stage that it is in right now, according to my volume weighted moving averages, is accumulation for what it's worth. All right, another one I want to take a look at here is CIFR. And we've seen a beautiful recovery in CIFR. This was one that I bought calls on the other month, made some nice money on it. And, I do believe that with Bitcoin recovering, it makes sense that we see, some of these, Bitcoin miner / data center provider plays such as CIFR, performing well, right? It was up 6% on Friday off the lows of 14, now 20 and change. And it's got the high of $25.52. So not that far off from there. So, as of right now, I'm liking what I'm seeing with CIFR. And speaking of data center plays, Bitcoin miners, one that I did take a position in, again, is Bitfarms. Bitfarms on Friday, even with the shortened trading session, we saw good volume. It did 114% of its 90-day average volume. So the volume is picking up again. It's in accumulation. We saw a bounce off that level of 250, which has proven to be support. It was support back in late September and has proven to be support for the past couple weeks back in November as well. And we've seen a clear break above not only the 61% Fibonacci level, but also the key psychological level of $3. It was up Friday over 12% on the day, closed at $3.48. And so, on Wednesday before Thanksgiving, I got into, I believe, some May $8 strikes on Bitfarms. But I believe that, this thing has legs. I believe it has room to go. So, again, this is a tie with, basically Bitcoin, right? It is a Bitcoin miner, so it is going to be somewhat dependent upon how well Bitcoin performs, but it does seem like we found a floor on Bitcoin, and this thing has been beaten up from those highs of 660. So it would make sense, in my opinion, to see a recovery towards the end of the year, especially if the Santa rally is indeed on, which it seems like it is, and we get rate cuts. I could see Bitfarms retesting 660 sooner than you think. So as far as the options chain for Bitfarms, you had a put to call ratio 0.23 on this. So again, very bullish there. All right, let's do a quick check-in on the major indices. First of all, I want to take a look at the S&P 500 via the ETF SPY. We were up 0.5% on that shortened trading session on Friday. We did close at 683.39, and we are back above all major moving averages and not that far off all-time highs of 689.70 now on the S&P, which is great to see. And this is why I say I believe the Santa rally is back on. Yeah, we spent some time below this 50-day moving average, but we are now back above it, folks, cleanly back above it. And we've had literally 5 days now of buying pressure on the S&P. And it looks like that we want to get a breakout to a new all-time high. You got the RSI sitting at 59, so we had a nice cool off on the RSI. We were at one point at 67 for SPY back on October 27th, and we saw lows on the RSI to 35 back on November 20th. So we've had a nice reset on that, and I think towards the end of the year, we could see a push to that 700 level on the S&P. All right, let's do a quick check-in on the tech-heavy NASDAQ via the Qs. Same story. Clean, beautiful bounce off the 23% Fibonacci level of 581 and change. And really 1, 2, 3, 4, 5 green days in a row on the Qs. Back above all the major moving averages. Sitting at 619 and a quarter as of Friday's close. And not that far off all-time highs of 637 on the Qs. Quick check-in on IWM. The small caps also doing beautifully. Did have a brief breakdown below that 23% Fibonacci level, as you can see here, but we did reclaim it back above all major moving averages, and also not that far off all-time highs, sitting at 248 on and change on Friday, and all-time highs at 252 and change. So getting awfully close there, and if we do get a rate cut, that's obviously going to help IWM, and I would say there's probably a bit of front running ahead of that December 10th rate decision that we're seeing right now. Quick check-in on the VIX. The VIX back below the 200-day moving average, currently sitting at 16, so below 17 on the VIX, after we saw some insane spikes all the way up to 28 with the AI valuation fears over the past couple weeks, but good to see the VIX back below the 200-day moving average. And let's do a quick check-in on Bitcoin at time of recording. Bitcoin looking great, up 0.7%. As you can see here, we had a clean test of that 50% Fibonacci retracement level. A beautiful candle there where we, basically bounced right off of it on volume. Kind of a bullish indication there, like a hammer candle. And we've had some nice recovery there. And as you can tell right now, we are testing out that 38% Fibonacci retracement level right around 91,500. Again, at time of recording, Bitcoin at 91,470. A clean break above this should give us a retest of the key psychological level of 100,000 on Bitcoin. So I like the recovery that I'm seeing in Bitcoin, and that's why we're seeing some of the Bitcoin miners such as CIFR and Bitfarms performing well over the past week. This is TradingView for anyone interested in new trading software, especially right now with Black Friday deals, Cyber Monday being tomorrow. Make sure to check out TradingView. Check the link in the description. You can get $15 off. All right, let's move on to some macro news. So first of all, let's go back to our good old friend Equity Clock, as we do every month here on Stonkcast, to take a look at seasonality trends, right? For all of my, swing traders out there, this is a great tool to use to get an idea, and for day trading, right? To get an idea of, what does the month historically tell us over the past 20 years as far as bullish, bearish, indifferent, what is it looking like, right? We already talked about last month how November is the second most bullish month out of the year, second to July. July average return over the past 20 years is 2.5%. That is the highest out of any month in the year. November's 2.3%. December is 0.6% average return over the past 20 years. Max return we saw in 2010 of 6.5%. And minimal return was in 2018, where it was down nearly 10%. So, December historically is a pretty bullish month. Again, average return of 0.6%. And you can see from the graph here, for those on YouTube looking at Equity Clock here, and again, this is a free website. Anyone can check it out. Typically after Black Friday, the following 2 weeks are pretty bullish. And you can kind of see that represented in the chart here over the past 20 years. And then, mid-month, we get a bit of a downtrend before really we just soar, right? So basically, first couple weeks, I would expect some slight greenish activities, some slight bullish activity, and then maybe some consolidation before, the final 2 weeks, the back half of December, historically, right, is when we rip. I heard a stat that something like 75% of all retail revenue is generated this weekend, right? Basically, the Black Friday, Cyber Monday, this entire post-Thanksgiving weekend is when majority of retail revenue is generated for the entire year, which is just insane. So the consumer, hopefully, right, we'll see the data as the numbers come out in the following month, but the consumers hopefully are out strong right now, which this market is built up. A big portion of it is built up on consumers. So we want to see strength there. And I think that's part of the reason why we see, historically Santa rallies happen. So that's what we should be in store for in the month of December, right? Heading into the end of the year, we should see a lot of bullish activity. And historically, the month of November was pretty bullish, but obviously we had some nuances there. Same thing could happen in December. It's not a guarantee, of course, but historically, this is what we could be looking at. All right, let's move on to this piece from MarketWatch. Supermicro Oracle headlined this list of the worst performing tech stocks in November. So investors are exhibiting more scrutiny around AI players, and that has led to some pain in the tech sector during the month of November. MarketWatch looked at the performance of 84 major tech stocks and found plenty of red, as 63 of those stocks had suffered month-to-date declines through Wednesday's close on a total return basis. Among the biggest losers are some former AI darlings that have lost their shine. Take Supermicro Computer, whose shares saw the sharpest decline of 36.8% for November through Wednesday. The server maker is still seeing booming AI demand, but its margins have come under pressure from steep competition and rising costs. The timeline for improvement remains vague, and investors likely remain weary. Raymond James analyst Simon Leopold wrote after the company's earnings report earlier in the month. There's also Oracle, whose stock has more than wiped out massive gains seen earlier in the fall upon the announcement of new business with OpenAI that increased the company's backlog by multiples. Now there are concerns about whether OpenAI will be able to follow through with its commitments to Oracle, which has taken on debt to finance its AI-fueled cloud expansion. You also got Palantir. Palantir was down 17.3% for the month through Wednesday, highlighting how investors have come to pay more attention to its valuation. The stock has still more than doubled on the year, and MarketWatch's Christine G explained how Palantir became a cult stock who bet big on the company. Advanced Micro Devices, another one, AMD, meanwhile, could see its worst monthly performance in 3 years. The stock was down 16.4% for November through Wednesday. So these are just some of the bigger losers that we've seen in the month of November. I mean, look, I just got done talking about how November is the second bullish month, most bullish month out of the year historically over the past 20 years. But just because that's been the trend over the past 20 years, you can have nuances, you can have one-offs. It's not a guarantee, right? And obviously we, saw some bearish activity in the month of November in certain key tech stocks, as this article lays out here. My thing is taking a look at some of these companies. If I'm looking for a swing trade or an investment entry, ask yourself, do you think Oracle and Palantir are going to continue down in the next year? I don't think so. I think the growth, the insatiable appetite right now that investors have for anything AI is going to continue, right? I think we're right in the middle of it. So, maybe right at the beginning, depending upon how you look at it. But, these could be some companies to look at for potential entries. Palantir, for example, if we just pull up that chart, look, it had lows all the way down to 147 off highs of 207 not that long ago, and already back above the 5-day moving average, still above the 200. I mean, if you're looking for an entry into a swing trade, for example, like as I'm looking at this, I would want to see, maybe a break above 175 for further validation, as this was a, previous level of support, and want to make sure it's not resistance now. But in either case, I mean, if you just are running through charts and this comes up, this looks like a nice entry for some more upside. So yeah, we've seen some weakness in some of these players, but I don't think it's going to continue. And, as Warren Buffett says, you want to buy the fear, right? Sell the greed. Oracle, this one is technically below the 200-day moving average. That is not great, especially after the highs we saw of 345, just massive upswings there. But, for what it's worth, this is technically, according to the RSI, an oversold stock. So I would wait for confirmation back above the 200. But for the long haul, right, if you believe in Oracle, this is where you want to be buying shares. You don't want to be buying shares up here in the 300s. You want to be buying shares down here in the 200s. And it looks like, it's setting up for that right now. So very interesting stuff here from MarketWatch. And let's move on to this piece here about the Fed rate decision. So as this article lays out here in the title, Fed hawks and doves are battling over December rate cuts. Watch these close to see who wins. So here's what we know about employment. September non-farm payrolls rose 119,000, more than expected. Rebounding from a downwardly revised loss of 4,000 in August, the pattern of downward revisions continued with 33,000 jobs removed from prior months. This leaves the 3-month average at 62,000, up from 18,000 in August, but far below the 232,000 pace at the start of the year. Given the persistent revision pattern, the 190,000 figure is likely to be revised down as well. Here's what we probably know about the October labor market, because keep in mind, we had the government shutdown, so we missed some data. Excuse me. Broad alternative indicators show little improvement in October. Private sector surveys of manufacturing and services firms point to contracting employment. ADP data showed minimal gains. Private sector measures of job openings and small business surveys indicate softening labor demand. Private sector layoff measures have increased, although weekly unemployment claims remain contained. So the Fed struggle with all that said. Whether employment weakness is driven by labor demand or labor supply is a key fault line within the FOMC. The labor market remains the pivotal factor that will determine the pace of Fed easing. The 10-2 vote at the last meeting for a 25 basis point cut featured dissents on both sides. Governor Stephen Moran favored a 50 basis point cut, while Kansas City Fed President Jeffrey Schmidt voted to hold rates. The September job report will not have changed those positions. Hawks can point to the rebound in headline job growth in a context of still high inflation. Doves can point to the rising unemployment rate, negative payroll revisions, falling wage growth, and weak job growth in cyclical sectors. So, really, the Fed is in a tough bind, right? They're in a tough bind because, they want to keep inflation in check, but then, they also have to stimulate the economy from the labor side, right? So they have a dual mandate of maximum employment and keeping inflation low at 2%, which has been the target, right, for the Fed, but it seems like that is now changing to maybe more of a 3% policy change. I'm not sure exactly how to put it, but it doesn't seem as black and white as 2% anymore. It seems like the Fed is kind of putting up the white flag there on that front. But the Fed, nevertheless, for this December meeting is really in a tough bind, because if they begin to cut rates further, that could push inflation higher. If they hold off, the labor market could get even worse. And without, the October numbers, because the market was closed, the government was closed, they're kind of, as President Jerome Powell, Fed President Jerome Powell said, it's like driving in the fog with some of that missing data. Now, of course, the government's open again. We're getting some of that data back, but, we're not going to get, for example, some of that key labor data until mid-December post the rate decision because of the government shutdown the previous month. So that doesn't really help the Fed. If we take a look at the Fed Watch tool via the CME Group website, as of right now, we are baking in an 86% chance of a 25 basis point cut on December 10th. It's part of the reason why we've seen the overall market rallying, especially IWM, the Russell 2000 small caps. So as of right now, 86% chance of a rate cut. A week ago, it was 71%. So that continues to go up there. And if we do a quick check-in on the probabilities for, the month of January, beginning 2026, it does seem that if we do get a rate cut in December, there's a strong likelihood right now that we hold in January, meaning we don't have an additional basis point cut. However, that could change with some of that labor data coming out mid-December, right? Especially with some of the inflation reports in addition to that. But I have heard reports, if we just take a look at this, we are expected to essentially come off 100 bips by this point next year. So as of right now, that's where we stand. We got 10 days, folks, 10 days until that Fed decision. Going to be very, very important to, how the remainder of the year is going to look. This last month in December, the Santa rally and all that. I do believe that if we get that 25 basis point cut, that could be a lot of fuel to the fire for the Santa rally. All right, let's do a quick check-in on the economic calendar. Take a look at what we got coming out this week now that the government's back open again. Monday, December 1st, first day of December, Fed Chair Jerome Powell will be speaking on Monday We're going to get ISM manufacturing data, Chicago PMI, S&P Global Manufacturing PMI. The big one, however, Tuesday, December 2nd, JOLTS job openings for September will be coming out at 10 a.m. Eastern. You can definitely bet the Fed will be paying attention to that. Wednesday, December 3rd, ADP non-farm employment change for the month of November comes out. Previous number 42,000 and forecasted 19,000. Some ISM non-manufacturing PMI, crude oil inventories comes out. Thursday, December 4th, we're going to get initial jobless claims. And then Friday, December 5th, the Fed's preferred inflation gauge will be coming out, the PCE, personal consumption expenditure. So we're going to get some interesting labor data this week, right? Although it's not the big one that the Fed wants. That won't be until, like I said, mid-December. However, JOLTS job openings will be interesting. Initial jobless claims will be interesting. And then the PCE report on Friday is going to be huge, in my opinion, because if that comes in line or under expectations, that could give the green light further for the Fed to make that rate decision on December 10th. As of right now, it appears it's going to be in line. The forecast is right in line with the previous for core PCE. 2.9% is what we're looking at for the forecast there. So that's what we got for the economic calendar. Quick check-in on earnings via Earnings Hub for the week. Some of the more notable earnings that we're going to be getting, we will hear from Dollar Tree on Wednesday before the bell, also Macy's, so some consumer numbers there. After the close on Wednesday, we'll get Salesforce, and that's just a few of them. We'll get Kroger's on Thursday. Not a ton happening, but still some notable companies reporting this week. So that's what I got for the market prep episode here. The last one for the month of November. Again, Monday kicks off the month of December. Definitely my favorite time of the year with Christmas right around the corner. Most wonderful time of the year. I hope you enjoyed time with family and friends for Thanksgiving, and very excited to see how we close out the market for the year 2025. We got one more month here. Let's see if we can close green. Let's see if we get a Fed rate cut. Let me know what your thoughts are on that and on Opendoor and on Bitfarms. If you think it can retest highs of 660, appreciate all the support as always. Make sure to share with a buddy. Don't forget to like and subscribe. Follow us wherever you listen to podcasts. And folks, as always, remember, plan the trade and trade the plan. Have a good one.